When it comes to buying businesses, there's the textbook version of how it's supposed to go, and then there's reality. Okay, one of the things I love about my co-founder at Acquisition Lab, Chelsea Wood, is that she never shies away from the truth. Okay, in this episode of Acquiring Minds, she's even going to share a story about how one buyer almost walked away from a perfectly good deal, not because the numbers got weird, but because the seller's personality threw him off. Okay, Chelsea and I have helped our members at Acquisition Lab acquire almost $500 million in small business acquisitions. And in this episode, she breaks down the 7 most common issues that stall buyers and how to handle them before they cost you the deal. Check it out.
Welcome, everyone, to this webinar, Buy a Business, Not a Fantasy, addressing this month's 7 most common buyer concerns. My name is Will Smith. I'm the host of the podcast Acquiring Minds. Today's session is with Chelsea Wood, co-founder and managing director of Acquisition Lab. As you know, the lab is a cohort-based education community for people serious about buying a business. Many successful grads of the lab have appeared on Acquiring Minds. Chelsea.
Hi.
The 7 deadly sins, most common questions. Remarkable that there's been so frequent these questions in the last month or even week. Give us a little context.
So originally, I wanted to do this session with lab members that have bought businesses with their wives. I couldn't get them, or spouses, I should say. I could not get them to be available during this time. So you and I were like, okay, well, what should I talk about? And the same questions kept coming up last week and this week on these calls, and they're not necessarily new, right? Everybody kind of has these same questions, but I was having the same conversations, and I was like, we should talk about these questions that everyone keeps mentioning, or statements even. And so I thought it would be a really good conversation. Right, because I think
Yeah.
everybody's kind of mulling these over in their head, and so
Yeah.
let's talk a little bit about the reality of buying a business as opposed to sound bites on socials.
Perfect. Let's dive in.
I wanna start off by saying that buying a business is nuts, right? It is crazy, but it's a good kind of crazy, right? Because with the risk comes great returns, but we all have to admit, when you tell somebody that's not necessarily in this world that you're gonna buy a business, they look at you like you're nuts, and it's because you kinda are. But at the end of the day, the goal, of buying a business, but you do not wanna do that at the expense of making a mistake, right? And that's where everybody kinda universally agrees. Um, we always say in the lab that our goal isn't actually that everyone that joins the lab buys a business. It's really just that they feel comfortable and educated and prepared for whatever choice they make. And that it can be to buy a business or it can be not to. But at the end of the day, I wanna make sure that you are buying a business and not necessarily a fantasy that's being sold on social media, which is what I think is happening more and more now. I also get slammed with ads, and so I can kind of see what's being put out there. And I think that there is and I've always said there's a glamorization, but I also think there's an oversimplification um, happening in what I kind of call clickbait headlines. And so I just wanted to kind of break it down. Anyone that's attended my office hours in the past knows I try to be very tactical with my feedback, so that hopefully this helps you kind of move further in your journey. Um, and so the first thing I want to talk about, and I think I've also I had a gentleman who was coming wanting to buy a business with no money down, call me a brick wall of reality. And so I do think that there's a level of realism that needs to be had in these conversations that you're having about buying businesses. So the first thing I want to talk about is how everybody wants to buy a business, not a job. Why there's a strong preference for management teams to be in place and what you need to think about. This concept of like, well, I'll stay doing what I'm doing, and the seller's going to stay on long term to make it easier for me to transition. No one wants to take a pay cut, which I understand. And then the other thing is like, how much capital should I be using? I don't know that I want to drain all of it. The other thing would be personal readiness. Is like, I don't know if I should be buying a company. Like, am I really prepared? And then the last piece is just whether or not LOIs are getting accepted. I will tell you this is a lot, and I told, Will that we can kind of gauge time, and see if I can get through all of these in a reasonable amount of time. But if so, we can, do the other half next month when I do office hours. But, the first thing let's talk about, and everyone has said it, everyone's read it, everyone's heard it. I don't wanna buy a job, right? You wanna work on the business, not in the business. And I think it's really important that you really sit with yourself when you're thinking about buying a business and you figure out if you're trying to get returns or if you want responsibilities, right? There's not a right answer here. It's just a personal preference. Do you want returns or do you want responsibilities? Successful acquisition entrepreneurs understand that they're going to get good returns, but they have to be willing to accept the responsibilities to get there. If this is you and you're wanting returns, then maybe you're more of an investor, right? Because at the end of the day, I saw this graphic and it just made me laugh. We always say at the lab, like owning a business is the most engaged life you'll ever have, right? And so I think that a lot of people are at this crossroads in their career where they're like, do I stay at my 9 to 5 job or do I go buy a business? And I think it's really important that everyone recognize that you will likely not work less. Honestly, some people I talk to, you'll definitely not work less, right? Because they've figured out a way to be very efficient in their corporate roles. And when you are a business owner, you are like you are it, right? You are the owner. The buck stops with you. And so to combat that, a lot of times people will say, "Well, I'll just hire an operator," right? Okay, yes, you can do that. But my primary question to you would be, is hiring talent a strength for you? Like, have you done that before? Do you know how to vet candidates and figure out who the best person is? Because hiring is really complicated. As somebody that did executive recruitment early in my career, like not every hire is a good hire, and it's a painful process when you hire somebody and you put all of the authority on them, and they don't work out, right? And so, if you don't know how to hire people, then hiring an operator is not a great strategy for you. The other piece that I really struggle with in these conversations with people is like, okay, so you're going to hire an operator. How do you know what competencies are necessary for that role? Right? Like, you don't even know the role, you don't even know the company, so how do you know what to look for in an operator? The other option is like, okay, so I've asked questions of like, well, who's gonna train the operator? And I've been told in response, well, the seller will train them. Okay, so you're gonna have a seller train an operator, you're still not gonna know anything, but you signed the personal guarantee and taken all the risk. Like, it just seems like a very risky strategy. And I'll say it at the end of the presentation, I'll say it again now. I'm not saying none of this is possible, it's all possible. I mean, you could buy a business tomorrow without talking to anyone and doing anything about it, but doesn't mean you should, right? Um, the other thing you have to think about is like who's carrying the final decision making, who's going to handle crises, what happens. So Walker tells a story from stage a lot of times about how he was raised by a father that would, or maybe it was his grandfather, who would tell him on weekends, like when he's very calm, he's constantly killing people off in his head that work for him, right? And he just meant he was trying to figure out what's going to happen with this business if I lose this person. If you are hiring an operator and you don't know that business, what happens if something happens to them, right? How are you going to go in and be able to succeed? Um, and I do think you can do this successfully. Like, you can buy a business and have an operator, but it's a strategy that you set forward in the beginning. Like, we had plenty of lab members who come in and they're not necessarily looking for responsibilities, they're looking for returns. And so they bring on an operator that they're familiar with, right? They look to their network, they say, hey, I know this person, they're very good. I'm going to partner with them. They're going to be an operator. I'm going to buy a business that's right for them, right? And that's 100% okay, right? They're a partner. You're not hiring them off of a LinkedIn or Craigslist ad, right? I may have dated myself. I don't know if Craigslist even still exists. Okay, so at the end of the day, I think it's really important that we all recognize that you are a business owner, not an investor, right? And so even if you have an operator, at the end of the day, when shit hits the fan, it's you that has to answer the questions, right? Because you're the one with the guarantee. You're the one that has all of the risk, right? Whether you've collateralized or guaranteed loans, or even if you just took money from investors, you're the one that's accountable for whatever the outcomes are. And so I think it's really important that everyone recognize that you cannot work on a business without being in it first. And so this was a graphic that I saw shared from an influencer talking about automation and the ROI on automating tasks. And I just thought it was perfect for the same process for return on your investment of time as a business owner, right? And so in the very beginning of owning your business, you have to expect to be in it because you have to understand it. And if you attended my office hours on the first 100 days, we talk about like how critical the first 100 days are for the long-term success. And so you should expect to be in the business a minimum of 6 months, right? Because that's just making sure stuff stabilized. up to maybe 2 years before you're able to replace yourself and move on to growing the business. And then as the time goes on, you'll be less involved, right? Because you will have built the business to operate without you. But the worst thing I think that can happen is for you to suddenly only be looking for returns and then to be drowning in responsibilities because you didn't realize that the idea of owning a business and being not involved, it truly involved, meaning like, yes, you can delegate, but like somebody has to step in when a customer starts to drop out or something happens with a supplier or there's some kind of crisis. Like this is going to be you. And you just have to be okay with that. If not, then you should take more of an investor route. This is just a snippet from the first 100 days toolkit that I shared during my first 100 days office hours. It's just really important that you understand that you have to be in the business because you have to stabilize and protect the asset you acquired, right? And so you want to be focusing on building trust with your workforce. You need to establish yourself as a leader. You need to make sure that all the pipes are connected, right? Like I think there is a gross under appreciation for the tedium that is required to actually get the business transition to you. Like, I can remember having, challenges just with the small company we acquired in, April of last year with getting, Stripe to work correctly, so that we could take over the Stripe account, right? And so there's a layer of, um, like, tasks that I think are being underappreciated, and people are like, "Well, it's okay, I'll just have somebody else do them." Have you ever tried to have someone else call your bank for you or your credit card company? I mean, this has to be you. And so I do know that it's probably an unpopular opinion, but it's Chelsea's opinion only. I'm not stating it as fact. I truly believe that the length of time you stay working in a business is actually more influenced by your ability to delegate and your desire to grow the business and scale than actually what size company you buy. I think that if you have the skills to actually grow the company, then you can get out of the company as well. And so it's a to me, it's a personal choice and a skill set. A lot of times to combat this idea of buying a company, or buying a job versus a company, they'll say, "Well, I don't wanna buy a job. I wanna buy a company, so I need something that has managers in place." Because the thought process that they can run the company as you go and do whatever you're working on. So a lot of times the conversations will revolve around, like, I'm looking for an absentee or semi-absentee business. Just because I think it bears worth mentioning, even if the seller only works 4 hours a month or 4 hours a week because there's a management team in place, it's because they likely have worked many, many hours prior to get to the point where they can work 4 hours a month and still be effective. And so the idea that you can take over and put in the exact amount of effort they're doing is just not realistic, right? Like you're going to have your own learning curve to get through. And so we always say, like, whatever the seller says they spend on the business, you want to multiply it by four. And so truly understand that you'll get there, right? We all do. Think about a new job, right? Just because somebody did something really quickly because they had their own process in place doesn't mean you could step in and do it exactly like that in day one, on day one. And let's just say that you can, right? I've had conversations with people that are like, well, if it was operating without them, then it's fine. I'll just take over. Totally okay. But I also think it's important, and I try not to give you guys too much, psychology or research, but I do think it's important to recognize that research has been done to show that absentee ownership drives poor results, right? And so, yes, you can be an absentee owner, but you're the likelihood of your business closing is really, really, really high, right? Or the likelihood of your business not succeeding is really high. It's not like somebody bought a company and said, I'm not going to be involved, right? The idea of absentee ownership, there's a lot to it, where from a psychology perspective and a human capital perspective, and we'll talk about it a little bit further in the talk, people will disengage, right? Productivity will drop. You will not be able to have the level of engagement that you're hoping for because you set the culture. And so if you're not engaged, then why would anyone else care, right? If you don't care as the owner, then nobody else is going to care. It's actually, in my opinion, why I think a lot of banks won't finance absentee deals. And like the SBA won't allow you to be absentee. If you even mention the word absentee or semi-absentee to your lender, they should not do the deal because it's against SBA guidelines. Because at the end of the day, the biggest risk in all of this, and we can all agree, is execution, right? You're buying a company, there's a bunch of people involved, and you want to make sure that those people keep doing what they've always done to protect the historical performance that you acquired. Because at the end of the day, what you're really acquiring isn't the P&L, it's the people, right? And I don't think anybody would debate that, but it's the people that you want to be demonstrating organizational commitment behaviors or organizational citizenship behaviors, as it's called now. This was actually what my master's thesis was about because I think it's just really important that you understand how to breed a culture of highly engaged workers, right? These are the behaviors that we all want. These are the behaviors where um, you have employees that really own your business and the success of your business. And the way to get this is by not ghosting, as a new owner, right? You need to get in there and build trust. They need to see you walking the floors, meeting everybody, communicating, having open lines of communication, and doing all the things that we talked about in the first 100 days office hours. Without doing that, if someone else is doing it for you, that's a whole nother challenge. Like you have no control, but all the risk. But this needs to be happening, right? Um, the question that I get often is like, okay, so I want an engaged workforce. I would want to be doing the things where people will understand that yes, the business is being acquired, but they're safe, right? I don't want to lose the entire workforce that I'm acquiring. But how do I know if the management team that I'm acquiring is actually committed and is performing at this level when I don't have access to them prior to close? It's not easy, and this is one of the biggest challenges that you guys have. And this is just a little snippet from the operational due diligence office hours that I did. There are questions you can be asking to the seller in your due diligence conversations so that you can get a handle on how empowered the management team actually is. You can ask them to walk you through a typical day. You can ask them the last time they took time off and a decision that was made, or like the last time a crisis happened and how it was handled. Really to dig into the way that the company functions to give you an idea of how the management team actually performs. Some red flags that you want to look for. You want to make sure that number one, they're giving you specific examples. If it's very broad, then it's possible that the management team isn't actually empowered, right? That they don't act without with any authority, that they have to defer to the owner. This whole like, oh, everybody does everything mentality is can be really challenging. Um, I wanted to give you guys a way to kind of grasp what I mean when I say this. And so here's two companies that we looked at. Obviously, I changed the name, but ABC Services is target A, XYZ Services is target B. On paper, most people were more attracted to target A, and target B was seen as too small. However, when you dug into how it actually operated, ABC Services was had an owner, a founder, it had a management team, it had quite a few staff. It has, I think there was even a supervisor included in that. However, it turned out that none of these people actually were involved in operations. Everything was still done by the owner and the founder. And so this leadership team wasn't actually empowered to function. Whereas XYZ Services, by title, it didn't look like there was a management team in place, right? They only had a founder, they had an admin, they had a lead salesperson and a lead tech. However, when you actually like dissected what they were doing, the admin was running all day-to-day operations and the leads were coordinating all service delivery. So the owner was really only focused on growth, which is great, right? As long as you're the person that can step in and focus on growth, that would be a company that wouldn't need you to be involved in the day-to-day operations. Still not absentee, but not involved in the day-to-day operations, right? Whereas Target A, you're buying honestly just bodies, right? And so it's really important that you make sure that when you're acquiring a company that the team is capable of performing at the level that you're expecting. And so I had a client very similar to Target A, and it took years. I think I worked with them for 18 months on a leadership development plan just to get the management team so that they were actually capable of functioning in a basic management role, even though they had the title. And so it's really important that you understand the skill level of the teams that you're acquiring, not just the titles. Because at the end of the day, what you're really actually wanting, it's not just a management team, it's actually just an empowered team, right? A high performing team, a team that owns the performance of the business, and it's not just all driven by by the seller. So a lot of times to combat this kind of thought of like, okay, well, there's a management team in place or like the seller's there, I'm just gonna retain the seller for a few years, and then I'll transition slowly when the business can support it. I know I've shared in the past that I'm a car nut, and so this is a Bugatti Veyron. My son is obsessed with them. It is about $1 million to $3 million car, depending on who you buy it from and what it's got involved. But I just want to. This is the most basic example, but I just want you to sit with it. So you're going to buy this car, right? You're going to pay $1 million to $3 million for this beautiful car, but you are going to let the seller keep the keys and continue driving it. You're going to make all the payments. You're on the hook for any accidents they cause, maintenance, repair. They have zero incentive, right? They're not tied to it. You could maybe make them like carry a small insurance claim, or insurance policy, so that if they were doing something, maybe they were partially liable. But at the end of the day, it's your car. So legally, you are liable for anything that happens in that car, right? You would not do that. Nobody would let this guy drive your Veyron if you actually put $1 million to $3 million in on buying this car, right? It sounds completely absurd. To me, when I hear somebody say, I'm going to have the seller just keep running the business after I pay them, like, what is this guy who's driving this beautiful car? What's his incentives now that he's gotten $3 million in his pocket, right? Like, there's not a lot. And so, what's the point? And let's just say that you do seller financing, right? Okay, so why? Why? I just don't understand why. It's very illogical, right? To think like, so you're going to pay him to do something and hope that his incentives are the same. I also, just for sake of argument, want everybody to think about, if you've ever had a job and you've reached the point where you're out of the job, like you want to go look for another job, how engaged were you at the decision of leaving that job? Right? You check out, and the sellers are all doing the same thing when they exit. And so the idea that they're going to be performing at the same exact level that they always did to maintain historical performance, it's just flawed logic, in Chelsea's opinion. Um, there's a lot that can happen when you keep the seller involved that you may not actually be thinking about. The biggest thing is that there's just confusion, right? Like, you're creating this very nebulous, confusing environment, and so you cannot tell people, and that's fine if that's what you want to do. But there's a power struggle often between a new buyer and a seller where you can't actually make change because it's the old school versus the new school, right? And if they could have made the changes, they would have made the changes. And so you're buying this company, so it could just be in a holding pattern. And so that doesn't make much sense. And then the other piece that I don't know why it doesn't seem to get mentioned and people seem to be unaware is you can't actually keep the seller involved if you're doing the SBA for more than 12 months, unless they're retaining equity. And then that's, with the new SBA guidelines, pretty unlikely because they have to sign the guarantee. But like, it's not even allowed, and so the strategy really doesn't work past 12 months. And again, I'm not saying it's not possible. There are a million ways to get all of this stuff done. I'm just saying that these are not the least risky way to buy a business when you have collateralized a loan or personally guaranteed something. So the most common thing that I've heard is that I don't want to take a pay cut. And I get it. Nobody wants to take a pay cut, right? I'm making this amount now. I obviously don't want to take less. Again, not drowning you guys with research, but CEO compensation, high levels of CEO compensation have been directly tied to lower performance, right? And the reason is because the more you pay executives, the less you're investing in the business, and you will have a much higher return on your investment if you invest that capital in the business, right? And so I would highly suggest you start with, how much money do you need in your pocket every month to maintain your standard of living, right? Boil it down to the basics. I want this amount of money in my pocket every month, and that is at the absolute minimum, and that's non-negotiable, right? And then that's what you pay yourself as a salary year one, right? If you can take more money, cool, but don't plan on it, right? And then, in a perfect world, if Chelsea got to design this and have everybody do exactly what she said, I would have you stair step your pay in line with how the business performs, right? And so you take the minimum this year and you're reinvesting whatever's that delta is from what you thought you like what you stepped away from and what you actually needed, and you invest that delta either building your cash reserves up or in growth strategies, right? And then as the business increases performance, you can pay yourself a little bit more. Because I think what's really hard for people to understand is like, and I started to build a slide and it just got super complicated because I can't guarantee performance, but like, you're buying a business that's multiples more, right? It's performing on an earnings level multiples higher than you're paying yourself, right? And it's because it's paying down debt. So as you pay down debt, you're going to be paying yourself more, right? You're going to have access to that earnings. And so, yes, you're taking a short-term pay cut, but you're really thinking about the exit, right? Like over time, it's going to pay you more. When you're doing this, there's just a mindset shift that has to happen, right? Employees want the highest paycheck possible because there's no additional upside, right? You don't have anything gaining equity, so nothing's appreciating. There's just no everything's limited, right? There's no control. But as a business owner, it's your wealth is unlimited, right? It's just up to you to decide how high, how far you can take this, right? You've got an asset that's appreciating over time, and so you want the lowest paycheck possible because every dollar that you take out of that business actually decreases the value of the company, right? And so it's just a wealth building mindset shift that has to happen when you go out of being an employee to a business owner, right? And so you currently say, I can't afford to take a pay cut, but it's not about taking a pay cut, right? It's about delaying the money that you're getting, right? It's going to pay off exponentially more if you take less now, and keep that money in the business and grow it. And so if you can get away with $125,000 salary, then that's what you take, right? And then you stair step it up over time, because you'll get multiples on the money you don't take upon exit. And typically, your business will grow exponentially, if you invest that money now in growing it, right?
So when you have people worried about taking a pay cut to buy a business, they, I mean, some people come into this world and they're quite high earners that they could be earning north of two, three, even $400,000. For people in that strata, they're unlikely to be able to get that same level of income in the first few years, if you had to generalize, right? I mean,
Correct.
what owners, new buyers, then owners typically pay themselves in the early years are in the 100 to 20, 125, 150, maybe 175, right? That's kind of what people's expectations should be as a broad generalization.
I would say, again, as long as you're buying a business big enough to pay yourself what you need to, it's fine. But like, I would think that it's going to be hard to pay yourself over 200,000 unless you're buying really big, right? Um, because you have to have money. So the worst thing that you can do, and I'll talk about this in a few slides, but is draw money out to put in your pocket and leave no money in the business. The number one reason businesses fail, whether they're acquired, started, or just in operation, is cash flow, right? Cash flow management is the biggest downfall of businesses. And so you do not want to suck all the money out of the business that you acquire, to put it in your pocket. And so, yes, we have a lot of high earning, lab members, and most of them are going to need a minimum of 200,000 to pay themselves in order to support their standard of living. And so you just need to make sure you're acquiring big enough, right? And that might mean and again, our members are well capitalized. And so they might be putting in more money, or they might bring in an investor, which we'll talk about later. But yeah, I mean, I had a gentleman that was like, I have to make 750 a year. Um, or my wife won't support this. I'm like, well, yeah, keep doing what you're doing or get a new wife. Like, you can't pay yourself. You don't buy small businesses to collect big paychecks. That's literally not what it's about, right? Most banks are going to require you to pay yourself 125 at a minimum. And then, but if they look at your expenses and your expenses require $200,000 salary, it will have to pencil at a $200,000 salary. So to counter that, right? So then you'll have, okay, well, I can take less money, but that means I can't use the capital I was going to use as a down payment because I need to lean on that, right? Because I'm taking a pay cut. Okay, so then let's talk about what that looks like, right? And so I feel like when people are like, I can't use my money because I'm protecting against downside risk. Unfortunately, there are some unintended consequences of these strategies, and I just wanted to make them clear. I'm not saying not to do the strategies. I'm just saying if you do them, be mindful about the implications of doing them. So seller financing, hands down, is what everybody tells me they want to use. However, seller financing is actually a much higher likelihood of putting you in a cash crisis because it's shorter terms. And so I just saw, I don't know how this happened, but somebody signed a 1-year seller note, like a balloon 1 year. And there's a million reasons why you shouldn't do that, just to be clear. But like the biggest one is that you can't refinance until you've had typically 2 years of performance under your belt. The banks won't touch you. Right. And so, it's really important that you don't agree to short-term seller financing to like close a valuation gap or something. But most of the time, sellers don't want long terms, right? 5 years is kind of pushing it. But to expect 10 years is it's why seller this whole like SBA change of requiring seller notes to go on standby for 10 years is so controversial, right? Because what who wants that, right? No one. The other thing about seller financing is it makes it really hard to actually separate yourself from the seller because their payments are dictated by how you run the business. And so they're going like they want to stay there and talk to you and make sure that you're not screwing things up and have an opinion and it's just really hard to get them out the door because they need the money from you, right? So they need you to not fail. But the biggest issue that I see with seller financing is it causes a cash crisis in year three. Um, because that's a lot of times 3 or 5 is when balloon payments are due. And so the debt service is a lot higher, because it's amortized over shorter periods of time. And then if you do a balloon payment or something, a lot of times then, you're doing okay, and then you're not, because you have this big payment due. So just be mindful about seller financing. It's not as great as it sounds. Um, Honestly, SBA, that's why SBA, like, yes, it has, implications of signing a guarantee, but it's really that's why they call it cheap, right? It's a 10-year term, and so it as burdensome as it is when you finance 90% of a business, it's a lot better than if you were trying to, do it all through seller financing. The other thing that you'll see is people trying to minimize their down payment, and so they'll say, "Okay, well, I'm only gonna put 5% down." Um, that's unattractive to many, many lenders. I only know of one that will approve it. And so I don't recommend over levering the business and trying to lever 95%. 90 is already heavily levered. Private equity will do a 40/60 because that's ideal, quote unquote. So as you can imagine, if heavy lever is 90, 95% is really, really heavy a debt burden. And so it's just kind of it's a lot, right, to put on the business. And again, if you want to do this in the least risky way possible, it's putting a lot of a financial burden on the business. Seller equity for down payment, so that's a big thing, but now that it's requiring, the sellers to sign, the personal guarantee, it's probably, unlikely that sellers are gonna agree to that anymore. But it can also make it very hard, right? You've got new, like, new leadership and old leadership kind of fighting about making changes, and so that's never great. Earnouts are disallowed by the SBA, and so, I hear people talk about them, I see them in LOIs, but just as a heads up, you cannot do them in the SBA. That's where forgivable seller notes come in. Search funds, are one strategy you can go with, but you're kind of giving up control and governance. And for lab members anyway, most lab members don't want to answer to a board anymore. They don't want to be told what to do. They're buying a business for autonomy and freedom. And so search fund doesn't really answer that. Investor capital, there's a lot of funds popping up that will invest in small deals, meaning sub 5 million, using the SBA. And that typically will require you to use 2% of the down payment, and then they'll bring in the rest. But the caveat there is that their deal size is a little bit bigger, and so, you need to make sure that you are an appropriate buyer for a business of that size. Um, and having somebody to, report to can sometimes be frustrating. And the other thing is if you're using investor capital, whether it's a fund or a family friend, is it's really hard to get people to actually write you checks when they're not familiar with investing in this space, right? And so at the end of the day, it's hard for them to really get comfortable writing a check, so it can cause you to lose a deal, kind of the 11th hour. I think that some of these strategies will lower your risk from a financial perspective, but it's at the expense of the execution risk, right? And so to me, it jeopardizes the longevity of the company because you're creating cash constraints by over levering. And there will be times when you do need to have cash reserves to tap into. So I don't think you should be using all of your capital to buy a business. Maybe it means that you need to save for a little bit longer, or maybe it means that you need to work with an investor. But you should have post-close liquidity, even though not all lenders will require it. I think you should require it of yourself because it gives you something to fall back on should shit hit the fan, and you can't make payments, or you need to replace an engine or a truck, or something happens that's unexpected. The J curve is real. The business will likely decline initially, and so and then working capital is almost always underestimated. And so it's just really important that you have something to fall back on. I will tell you, lab members historically have had to do capital infusions in their first year because of unforeseen things, right? It doesn't mean you're doing anything wrong. It doesn't mean you failed. It means that businesses are not houses. They're not just assets that sit there and you put a tenant in it and it is what it is. Like they are complex systems with can have pretty big implications from a cash perspective that you need to have a plan for, right? And so having cash reserves is actually really important. Um, I do think that investor capital is one of the least risky ways to use the least amount of your own money. Whereas I do think that seller financing with aggressive terms is actually like a cash flow kiss of death. I think seller financing is really great for a risk mitigation strategy, but I think for a financing strategy, it's just painful. Um, the last thing is like trying to figure out if you're ready yet.
It feels like you're pretty negative on seller financing overall. But I think it just needs to be clarified that it's not seller financing itself that's the problem. It's just that usually the terms of seller
Correct.
financing in this world can be onerous. So
Correct.
important distinction there. Seller financing isn't inherently bad. In fact, it's financing. So
Correct.
and it's alignment of your seller with your interest. So in some ways it can be quite elegant, a quite elegant instrument. It's just so often the terms, it's a shorter term, so the amortization is tight and heavy, and there can be balloon payments and stuff. The terms can be quite onerous, right?
Yeah, and I think seller financing is literally how businesses have changed hands for decades, eons, right? I just think that there is a glamorization of seller financing happening, and people aren't realizing because it looks okay in the moment, right? Like they're like, oh, the seller's financing it, and it's like okay, but they're not thinking about okay, if I map this out from a cash flow model in year 3, when I have to make this balloon payment, it's a problem, right? Like, I think that the challenge with seller financing is the lack of understanding how heavy of a capital burden it puts on you. If you can seller finance a deal and the terms work and you can still meet your goals, build your cash up, finance your growth strategies, cool, right? All day long, fine. I think you do need to be aware of, the complications of, the seller not exiting, but it doesn't always happen, right? We have had several lab members by companies using seller financing only. I am somebody I just have to be me because I have a psychology background, right? So like I just think a lot about power dynamics. And again, if you think about this, doing this in the least risky way possible, it lessens your financial risk, but it can add some risk to the execution risk, right? Like, there's a story on our YouTube channel where Lucas talks about acquiring his company, and he still has a seller come and do things, right? So it can work. I just want people to be more mindful that, like, number one, I do think seller financing is used to get you to pay too much for a business. I've seen that way too many times lately. Where the valuation is just really high, and they're like, "Well, the seller's willing to carry half." Well, yeah, that's because it's only worth half. And so I do think that that's a little bit of a challenge. And I think that it creates an unnecessary cash burden in many cases that you're not thinking about. And
Right.
cash flow is really, I think if I had to boil down like business ownership and the biggest thing you need to think about being a risk factor is cash flow management, right? Like at the end of
Yep.
the day,
Yep.
you have to know
See
how to
that over
manage
and
your
over.
money.
Yep.
And so that's
Great.
that's really all it is.
Great.
Um, this leads right into that actually. So I hear feedback all the time, like I'm not sure if I'm ready. I haven't owned and operated something before. And so it's really important that you understand what your transferable skills are. I don't think you should buy a business if the seller it was playing a role that you don't know how to fill. Hiring people is a risky strategy. And again, everything I'm telling you guys isn't telling you to not do these things. People buy businesses in a gazillion different ways. I'm just telling you they are not, it's not the least risky way to do it, right? All of the strategies we've talked about, you just have to be aware that by executing on it, you're stacking risks, right? And we always talk in the lab about how we want to stack as little risk as possible, right? Because this is a risky thing to do inherently. Um, at the end of the day, you should be buying a business where you can leverage the things that you've already done well that have proven successful in someone else's business in your own. I do not think you should buy the business and use it as like a playground to like practice skills on, if it's personally guaranteed debt. If it's, you know, I don't know, a different thing where you're not, collateralizing a loan or something, okay, there's a little less risk there, but you should be relying on things that you've done well. Here's two different buyers. They're both fine to buy businesses. It's just they should be buying different businesses. So buyer one is early in their career. They've never led teams. They've never managed anybody. They've never had budget responsibilities. Buyer two has, right? And so at the end of the day, they could both buy businesses, but like buyer one needs to buy something that's small, right? Where they can develop those skills, right? If they go and buy a company, try to buy a company with a mature team and all this stuff, and they've never led, typically sellers and underwriters are going to look at them and say, no, like that would be too risky, right? They don't necessarily have the skills to succeed in this business. Whereas buyer two will need to buy a business, right, where they can leverage their expertise, right? And they will buy a company with a team because they're used to running, large teams. But in this scenario, underwriters are going to be looking for um, them to be buying a company where there's some alignment to their expertise, right? Whether they have a clear growth path leaning on some experiences that they've had in the past. I do think that this is becoming more and more important. I think the new SBA person and lenders in general, because the research that's come out about defaults happening in 2022 and 2023 were because there wasn't enough emphasis put on making sure somebody actually knows what they're doing when they buy a company. And so buyer one can go buy a company, but it probably needs to be a million or less. And it's probably one of these like buy a job situations because they've never led a team, right? And you're going to go buy a company with a team and figure out how to manage and lead and hope that you don't lose all your staff and learn the business and, try to grow it and do all these things. Like it's just too much risk, right? There's too much going on there. And so if I got to say like, okay, from an ideal world perspective, if the perfect background for a buyer would be somebody that has done budget oversight, right? They understand cash flow management. They have this operational kind of experience where they understand how businesses function. They've done hiring and firing and scheduling. And ideally, this is what we're seeing more and more brokers and lenders looking for is they want to make sure that you have experience with the workforce that you're acquiring, right? Like if you come from investment banking and you're trying to acquire, a manufacturing facility, they might have some questions, right? If there's nothing there to give that balance. Um, this is something that I've heard a few times, and I don't have a lot on it, to be honest. Um, but the important thing for you to recognize if you've submitted LOIs and you're not getting accepted is that it is a very, very crowded market. There are a lot of buyers. It doesn't always mean you're doing something wrong. It could mean that you are competing with private equity and strategic acquirers that are paying really high multiples. It could mean that you're coming across overly eager or desperate. I've had that with a couple buyers. It could mean, and this from applicants that have applied to the lab and like submitted their LOI, and we've kind of talked about it. They were overcorrecting for risk and putting all of the risk on the seller. Nobody wants to work with a buyer that does that, right? You have to accept that you're buying a business and it is inherently risky and do kind of put risk mitigation strategies in place, but don't overdo it, right? Because again, it's competitive. And so they're going to pick somebody that's not doing that. The biggest thing that I'm seeing these next two things is that whole leadership management experience, I am seeing this become where they're just not choosing the person that has never led, right? If they're competing on a deal where there's a team in place, they're not going to pick you because you've never led a team and there's risk in bringing you in to manage their team. And so it's just causing you to lose the LOI. And then the last piece I just recently ran into, um, which is asinine, to be honest, because the search funds came out where they weren't based in searching geographically, is I'm hearing pushback from brokers that there's not confidence that someone's going to close if they're not based in the geographic region, because they say they'll be willing to move, but then they won't. And then the deal falls apart. So I don't know if they've been getting burned by people saying they're going to do this and then not doing it. But that's feedback that I've been getting recently from brokers. So if you're seeing that your LOIs aren't being accepted, ask the brokers for feedback. Ask if there's anything you could be doing differently. Maybe it's that you're coming in lowballing offers. Maybe it's that you are being overly aggressive in your communications. I do think that getting feedback on your LOIs and your communications from lenders or attorneys or anyone is really important to make sure that you're not overcorrecting for risk. But then I also think that there's a desperation that seeks in with searchers when you haven't acquired and you've been searching for a while that can make you come off as high maintenance with brokers, and nobody wants to deal with that either. And so they might be selecting another buyer because of that. So again, I'm not saying any of this is impossible. It's just risky, and so do what you want. But these are the conversations I've been having on strategy calls, and so I just thought that you should hear it too. Because at the end of the day, the goal is to buy a business, but not at the expense of making a mistake. That's it.
Great, Chelsea. That was a lot. Thank you.
That was a lot.
First, just knock these out quickly. Are Q of E reports, quality of earnings, typical in the SMB world?
Yes, I think that should be
Yes.
done.
Yes.
On very
Um,
small deals, they may not be necessary, but like, yes, you should do them anyway because you should have that information.
what is an example of overcorrecting for risk? In your last slide or two, you mentioned overcorrecting for risk. What is that? Putting too much of the risk absorption on the seller?
Mm,
They're taking all the risk and you're not. So where is that line?
so like this is super common where I'll see where there's like 3 seller notes, right? And it's like this is correcting for this is this, asking for really long transition periods. Um, asking I'm trying to think of like all of the different ways, but it's really just how you're interacting, right? Like lowballing the multiple, right? Based or like recalculating SDE based on your own strategies. Like there's a lot of things that you can do that's basically saying you don't actually want to buy a business.
Well,
Right? Like
and I think one way to think about it is all these factors that we think about in terms of a deal are basically on a spectrum: price, high, low, seller financing, more or less, etc.
yeah.
And all of those are, if you just push all of them to one side, which is like that's too much on the seller. So this is just kind of negotiation stuff. Almost all of these are on a spectrum,
Yeah.
and you're pushing and pulling with the seller, and so don't have them all be weighted to the seller absorbing all the risk.
Yep. Same thing with like not wanting to put your own capital in. So like you're putting in 5%, but you're asking for the seller to have 22% seller financing. It's like, well, where's the like they're taking a hell of a lot more risk than you are. Like if
Yeah.
anything, it should be even, right?
Do you offer an opportunity for a deal review without necessarily becoming a full-fledged lab member?
No.
What if they are a full-fledged lab member?
Yes, of course.
And how does that look?
Well,
The
either through
the
our
search
search
forum?
forum deals or a lot of times they'll just get on my calendar. But that's also what the
Eh,
office hours are for.
what is the search forum?
Live deal review call happens every 2 weeks. If you're serious about a deal, then you get added to the agenda, and then we will tear down the deal with you, Walker and I, in front of 75 to 80 people who are also providing their insight and their opinions on the deals.
It's pretty great. I did that when I was still searching. You bring a deal you're interested in. It's a call not unlike this, except that you can see all the other faces, and it's led by Walker and Chelsea. You bring your deal, you pitch it, and then they unpack the whole deal, the terms, everything, and then the crowd also provides its input. Pretty valuable. I have decades of managing mid-sized teams, P&L, hiring, firing, marketing, business development. My weakness is acquisition and financing. How do you are you how much is finance experience a priority or not?
I guess it depends on what is existing in the company you're acquiring, right? If there's an internal team, that might be okay. Like if they have a CFO or a controller or something, but if it's all dependent on the control, like the owner or woman that owns it and their accountant, that's probably a challenge. Um,
What about for getting the deal done itself, just the deal piece?
no, the deal it shouldn't be a big, I mean, get someone to help you. But that's the deal is not the important part. Like you can get support, right, on the deal part. It's the operations that you would need to make sure that you're secure in, because
But
that's the part that
what would you say, Chelsea, is should be somebody's fluency with, say, Excel to get a deal done? Do they have to know their way around Excel? Or are they putting together a model?
ideally, I would have said yes long ago, but there are tools out there now that will kind of help you, plug and play. I think you should know Excel as a human, but I was an analyst, so of course I say that. There are companies out there that can help you with financial modeling. We have lab members who use one within the lab. Um, we teach you, right, how to use our tools. Our tools are going to be based in Excel. So, like, you kind of do need to know Excel, if I'm honest. You don't have to be a pro. Like, you don't need to do pivot tables and VLOOKUPs, but you do need to know how to enter a cell and do a calculation. But I would just say go get educated on those components, right? Go get
Yeah.
educated on the deal stuff. That's the
Yeah.
stuff you can learn pretty easily.
Yeah, and I would say I see this a lot on Acquiring Minds that, or among listeners, that they feel really intimidated because the finance piece, the financy piece of doing a deal is where they feel least strong because they might not have a finance background. And I share what you say, Chelsea. I would say try to learn what you can. But it's not, you don't need to have a finance background to do this, but you do need to get somewhat acquainted, certainly be comfortable looking at Excel and working with a model, a light model, not a super
Yeah.
sophisticated model, but like a one-page model. But that's learnable. And if you're
Yeah.
scared of learning something new, you probably shouldn't be going down this path to begin with, because there's going to be all kinds of stuff you're going to have to learn
Yeah.
to be successful at this in general.
Well, and I honestly, it's one of the biggest challenges. And the intensive is 8 sessions now, and 3 sessions that are like off that you do on your own. One of those is financial analysis, and two of the 8 sessions are financial based, right? So it's like it's a skill everyone needs, um, and everybody's, I think, has the most imposter syndrome around, but it's not insurmountable, right? You have a lot of people that you lean on that do have those skills. Just don't do it alone if you don't.
Is the acquisition lab relevant for non-US or for acquiring a non-US company? I'm in Canada.
Yeah, I mean, we have international members. We have one in, I mean, we have them all over, right? One of our members started the first PE fund in Guatemala. We've had acquisitions in the UK, in Portugal. We have one right now, going on in Germany. I take international candidates on a case by case basis. I want to make sure that your pain points, like, we can solve. And so Canadian's kind of easy. We have quite a few Canadians, honestly. We always have. So yeah, we've had Canadian closings way easier than the other countries. And so yeah, I would say yes. It's a little harder if you want to buy in the US though. So buying a US based company, especially under a current administration, is probably a no go for you, um, for a multitude of reasons. But we have members buying Canadian companies. Fine.
If my spouse and I have experience leading, budgeting, operating, and technical expertise between the two of us, will that be viewed the same as if it was one person with those skills? I guess by the lender
It
or the
doesn't matter.
seller.
Yeah, it's a positive. I don't know if it'll be viewed the same, probably not, because it's not one person, but yes, it's still valued because as long as you guys are planning on acquiring them together.
Yeah.
Yeah,
Yeah. I think people on the other side of the table are looking at the team on the other
correct.
in you. And so does all the people there, the one person or the two people or the more than that people, as a collective, do they have the necessary skills? Not is it all just in a single individual?
And I think it actually works in your benefit, to be honest. And I was going to talk about this on this podcast that I didn't do today, about buying with a married couple or buying with partners, I guess, but spouses specifically. One of the biggest pushbacks on the geographic thing that I was having a conversation with a broker, and they were frustrated because the spouse wasn't bought in, and so they got to closing, and the spouse refused to move, and so the deal fell apart. And so I actually think that you guys being represented as buying together, as
Yeah.
this unified front, can actually be a really big positive.
Yep.
And so, yeah,
Good
I
point.
like it.
Yeah. Great point. What are your thoughts on Rob's rollovers as business startups? Is that it's always such a weird
Something
what
like
it
that.
actually
We'll
stands
just
for.
call it Rob's.
Yeah.
So what are my thoughts? I have some. Um, it's a strategy that you can use. There are unintended consequences that I feel like they are not very transparent about, with Rob's. And so make sure that you are going in eyes wide open. We've had a lot of lab members talk about this in Slack, post close. But the big thing that most people don't realize is that the percentage of the down payment the Rob's is representing is the percentage of ownership that the Rob's has over the company. And so if you take distributions, if you take any money out, it goes in the order of that ownership split. So if your Rob's funds 100% of your down payment, it owns 100% of the entity. So distributions go back into the Robs, which is fine for some people. Some people that is a huge shock, and you don't want to find that out post close, right? If it's okay with you, it's okay with you. If it's not and you have a plan for buying out, it's fine. But I would just say go eyes wide open, um,
Yeah.
and it's fine.
And for those who don't know what Robs is, it's the ability to tap the funds in your 401k to use as the equity injection into the business you buy without a tax penalty. But yeah, then your 401k is literally the owner of the business or part owner of the business, and there's all sorts of implications there. It's definitely done. I've had a lot of, or
Mhm.
a large handful of Acquiring Minds guests do it, but are all of these knock-on consequences. So be very careful with it, and don't just lean on the vendor of Robs itself for
No.
to get your questions answered. Get some objective attorney or otherwise,
The
or
other thing
somebody
that
who's
they
done it.
don't Yeah, the other thing that they don't, often disclose is you have to open that same 401k for your employees. Um, and that can be a huge, like, "Oh, shit." Like, it's just different, right? And so it has implications. So, yeah, just get educated.
Going to the point where we talked about earlier, where the banks will require you as buyer to pay yourself a certain salary out of the business. And the point there, everybody, is that like you can't, when you're doing the model of the business, you can't say, "Oh, I'm just going to pay myself $20,000 to make it look like there's that much more profit in the business to make the deal happen," because they'll say you can't live on $20,000. That's not realistic. But if you have spouse cash flow coming in, why wouldn't banks be okay with that? Or in fact, would they?
Yeah, and so it's a discussion, right? If you can prove that you have secondary income that will pay your living expenses, you could negotiate with the bank to not budget for you to accept a salary. You could also just not take a salary and reinvest the money, right? And the bank's going to do what the bank does because they have their own procedures. No one's forcing you to take the money that's modeled. It's just what they're going to be modeling in order to make sure the business is financeable. But like we have young guys, girls buying businesses that don't actually need more than like 50,000 a year. And if you can prove it, then they're fine, right? Then the model can be 50 grand. But if it's just a basic human and like you're coming out of corporate America or you're just modeling, most banks are going to model 120 for salary.
So this goes to the absentee question, really. What are your suggestions for purchasing a business that is outside of your geographical area in completing those first 6 months? You had talked about the first 6 months. You should really be there in minimum, there, present, establishing your leadership, continuity, managing the transition. So, how do you think about geographical distance, Chelsea?
So I don't love first time acquisitions outside of your geographic area because I think it's again another risk that you're introducing. We have lab members do it, right? So it happens. If you're gonna do it, you have to kind of mm, be very mindful, right? You'll hear me say all the time, like you just need to be acting with intention. Like there's just things you need to be thinking about, right? And in this scenario, the thing that tends to f everything up is that no one's planning for the financial implications of the travel. And so it ends up draining the earnings of the business to cover the food and the lodging and the, mileage or right, like gas or airfare or whatever. And so it ends up creating an unnecessary burden on the business that for whatever reason they didn't plan for. And then you get into the cash flow issues, right? And so if you're going to be hands off, or I mean, hands on, but in a different geography, make sure that you're planning for the costs associated with it, number one, and then the other thing is a lot of people I talk to that are buying businesses are doing it because there's this like pivot happening, thankfully, in our society where people are valuing time with their children, right? It's like I talk to 9 out of 10 people and they all are doing this because they want to be present in their children's lives. And so I would just urge you to ask yourself why you're buying a business and whether or not your strategy is going to get you to where you're going, right? I feel like people are buying outside their geographic area out of desperation without realizing that it's not getting them any closer to what they were doing. And it's adding a lot other stressors that are unnecessary, right? Somehow buying businesses and like working for somebody else became enemies. And it's like you sometimes being an employee will get you where you wanna go actually more than being a business owner will for where you are in your life. And so if you're trying to be in your kids' lives, then going and living somewhere else 5 days a week is not a great plan, even for
Yeah.
6 months.
9 out of 10 cite that as the reason.
We have it. Yeah, it's kind of cool. I think it's awesome. Yeah.
To give people 60 seconds on the lab, please.
Okay, so the acquisition lab is designed to hold your hand as you buy a business, right? So we are full service in the sense of like it's lifetime membership. We will help you figure out who you are and what you should be buying and how to position yourself and how to evaluate listings. And then we have office hours every day. We have live deal review calls every other week. We have an active Slack community. We don't take referral fees from anyone. So you know if we're referring you to a provider, it's because they're good. They don't make mistakes. If any lab member tells me that they've made a mistake, they get dropped from a referral network. We have all the tools and templates and all of the resources you could imagine, and we're lifetime access so that we can support all of the deals that you do. And because it's not a linear path, right? Just because you decide you want to buy, something happens. I don't want you to not be able to continue that goal later, right? Like we have a lab member right now who went through divorce and rebuilt his capital, and now he's coming back to buy again. And so we're a community. Um, there are 11
Talk to us a
advisors.
little bit about the community, Chelsea, and the Slack group in particular. It's quite active. It was, at least it was when I was in the lab.
Yeah, it's so active that I flagged my Slack bill as fraud. Because it keeps doubling, which I get, right? Because our lab members don't go away. It's lifetime access, right? And so yeah, I pay a lot of money to Slack, but it's last time I checked, we had 500 active members on it every day. And so that number just keeps increasing, but hundreds of messages are sent daily, which I think is really cool. And so that's probably the primary place that we communicate. There's one advisor who only answers questions in Slack, and then of course I do. But our lab members, because we vet so heavily, are really qualified humans. And so a lot of times they just answer the questions correctly. And so I can come in and be like, love you guys. Thanks.
And Chelsea, how many lab members have closed?
I am trying to actually get finite data because it's been just me. And so I hired a executive assistant a couple weeks ago. And so she's going collecting actual hard data, but I think it's somewhere around 225, 230. Now that's total closing. So we have lab members that have completed multiples. And so probably the number of lab members is lower than that though.
So 225 to 230 transactions have occurred.
Mhm.
Some of those by the same person. So call it 200 people, let's say, give or take, have actually bought a business, are closers in the lab. And do you have a sense of the aggregate value of transactions? That was something that used to be part of your sponsor at Reed on Acquiring Minds.
Yeah, I mean, the average deal size for lab member is like 1.5, 2 million, like when we actually do the math, but we've had really big deals like 26, 28 million. So it would be skewed, but I would say easily 400 million
400 million in total
at least. Yeah.
transaction value. And I heard you just say you were just like, it's just me, but so I just don't want to leave people with the impression that you
Yes.
are the lab.
No.
What's the cast of characters? Real quick, not every name, but just like
Yeah.
roughly.
So we have 11 advisors, and there are 7 that do office hours. They've all bought and sold multiple companies. You can find their bios on our website. They're all acquisition entrepreneurs. We have one that's a technical advisor. He's an ex-intermediary, so he supported hundreds of deals. He answers questions only in Slack. We have a branding advisor, and then we have me. And so I still run the intensive. I no longer do all the strategy calls. As of a month ago, lab members started doing calls with me. And so now if you book a strategy call with the lab, you may talk to me or one of our lab members who will help you kind of talk through your strategy and determine whether or not the lab could support you or not.
And but to be clear, that strategy call is the first step if you're interested in the lab. It's a 30-minute call with you or somebody else there, and it's really figuring out if the lab's a good fit.
Yeah, and so I will say, like, we don't do sales calls. That's why I don't have a sales team. That's why we use lab members. It's really about like this kind of shit, right? Like talking through what your strategies are and why they may or may not work, and how much capital you need, and how big of a business you should buy, and what types of businesses might be a good fit for your background. But it's ultimately just trying to figure out if what you're trying to do is doable. I don't want to take money from anyone that we can't actually help, and we're a lifetime membership, so having you here and not be successful kind of would suck for everybody involved. And so it's, can you buy something big enough to meet your goals? Second thing is like, should you be doing that, right? Just because you have capital doesn't mean you should necessarily be buying a company. And then the last piece is just whether or not they want to talk to you again, because I don't want to bring you in if nobody wants to talk to you ever again. That part's really important.
Well, this is really part of the ethos of the lab is being real about this journey, and that it's not for everybody, and that there are real risks, and that there's a lot, as you opened your conversation of your talk with Chelsea, that there's a lot of over promising going on social media, and so you are the anti hype, as I try to be as well. So we are aligned there. So you'll get it straight from Chelsea and the team in those strategy calls, and she really does only want you to work with them if she thinks you could be a success at this. We got to call it there. Did you want to have any final closing thoughts,
No,
Chelsea?
if you are interested in having a call, reach out, email me. Oh, and I mentioned some toolkits on this session. If you want those toolkits, just email me, Chelsea at Buy Then Build, and I'll send those to you. That's all I got.
Great. Excellent work, Chelsea. That was really a lot of great information, and so timely, given that you're hearing these same themes over and over just in the last 2 weeks, really. Thank you, everyone. This concludes the webinar. Bye.
Bye.